Okay, I see we have a couple of us here, and as usual, I'm starting just a little bit early than I normally would. Let me close the other door here, and we'll get rolling. And again, as would be the case, because this is recorded, folks can always go back at the beginning and take a look at this and see what they might have missed. This isn't like, hi, if you missed something, if you're not here exactly when I start, that you've missed something. So, just to kind of get us going here, and I've got another person joining me. Hi. The main thing, what we're going to do today is we're going to work on Excel case 11, which is over in the Solve It textbook, is Morgan Wagner Machinery. Now, that's over on page 103, and it's a capital budgeting, and we'll talk about it a little bit. But before we do that, I want to make sure we do a little bit of housekeeping. Just to remind everybody, Excel case 6 was due today, and we've already done it. As you realize, we are working ahead, and the reason I am, as I say, each class, is that when we get to the access, i.e. the database cases, we might get slowed down. I don't know. Usually folks don't have much experience with that, so I try to kind of take that a little bit slower. So we're trying to bank some time here. The other thing is you have exam 1, part 1 is due, and I provided everybody a sample of that. Exam 1, part 2 is also due. I provided in some instructions. And when in yesterday, which was the Wednesday section, okay, which is section B, this is section A, I showed everybody an example of how you would attack that problem, exam 1, part 2. And so, and then I believe, if I'm not mistaken, I sent everybody in this section an email with a link to the YouTube video that said, hey, go near the end of the video and you'll see that example. So everybody's all on an even footing as far as that goes. Basically, what I'm asking everybody to do, okay, and you could use the Badger Jam, the Excel case from Badger Jams, okay, and there are several over here in the file section that you use to upload for the workshop part. And what I ask you to do is come in and change some of these variables. Rent, increase it by 5%. Advertising, increase it by 5%. Okay, and then and assume those changes, and then compute the selling price required to keep the break-even units at 1,147 units sold. And you'll see from that YouTube video that I did yesterday's class, that section, you'll see how you can accomplish it. Now, I had someone in this section ask me, I said, what would you use? And what you'd use would be the goal seek. Okay, so I'm going to leave it at that. I think I've given everybody as much help, as they need to see. Now we go back over here to the modules, and we are, of course, we're at week 4, and we're coming into that part, of course, where we're going to be starting to get close to spring break, and we're going to start to move into the Excel cases. The access cases, and that's why I'm trying to work us ahead. Now, next week, you've got a couple of exam quizzes. You've got a quiz on break-even and economic order quantity, or break-even and EOQ. Now, the break-even is going to come from Excel case number 6, okay? And if you have that case and we went through it, that's Badger Jams, you'll see that's that break-even. The economic order quantity, if I'm not mistaken, is case 7. Now, in the event you get confused, like me, or you forget, let me recommend that you do this. Go over into the welcome area, okay, and scroll down through all those resources, and you will find, okay, resources for the exams. There's a PDF file, load it, and it tells you what resources you can use for those exams. We'll open it up for just a second. And as you can see, financial ratios quiz was drawn from the Dabney case. And then exam one, I have a sample exam, and also these materials that are scattered through either the resources area or in that supplemental website. And then the BE, the break-even and EOQ quiz, Badger Jams, and I was right. The hardware nuts case, that's where we worked out the economic order quantity, and that's drawn from that case. Then the trend analysis quiz, that's drawn from case 5. So you can see I'm drawing quizzes from that, as well as the Stephen Few text, which is the show me the numbers text. Now I'm going to close this one here so we got a little more manageable. And I want to come down and let's go over into the files, and let's take a look at in the files the Morgan Wagner machinery, excuse me, and it starts over on page 103, okay, and that's in the Solid 6.0 textbook. You got to have the textbook with you. You're not going to get much benefit from this if you don't. And it's on page 103. It's spreadsheet case 11. Now, as you know, here in the files, okay, and what I try to do is populate this with some stuff. And you know, as I go through these cases, I work them and rework them and work them and rework them, so I'm tweaking them. So you'll find some, you'll often find some that I've done before, and I'm okay with you taking those and using them as an upload. The ideal is to upload what we work on. Now, that all being said, we're going to take a look at the student files, okay? And we'll download that. And we want to get Morgan Wagner machinery, that's MWM, and we'll open it up. And then we're going to save it to our desktop. All right. And so I'm going to save it as on my computer, on the desktop where I can find it. And I'm going to call it, I don't know, I guess I could call it Harmon Case 11, or your last name, Case 11, or whatever. And the main thing is this, that you save it to your desktop, okay? Now, after you've done that, the next thing I want you to do is diminish all your screens down and get down to your desktop, all right? Find that case, okay, and open it back up, and we'll be ready to go. Now, you ask me, why do I go through this ritual? And it's very simple. When we download something from the LMS, that is Canvas, it creates a view file, okay, which is not, it's a rendering of the file, okay, but it's not actually the file. So what you have to do is save the thing to another environment, and then it becomes a real file. This is how it's just, frankly, it's a way to, it's a security thing, and also a thing to keep the data levels low. But if you have it down on your desktop, okay, then you're ready to go to town, and then when we're finished, you save it, and then you upload it where it's supposed to be. And this is case number 11, Morgan Wagner machinery. Now, as is the case, as is true with all of these cases, okay, we're working with a classic business problem, and we work with the software, okay, to learn about kind of working with it, how to use it, as a way, also as a tool to help us see a situation about which we need to make a decision. Now, in this case, in this situation, this company, and they give you, as usual, the authors give you some background about the company. They want to buy a computer numerically controlled machine, okay? This is a machine, let's say if in a garment factory, this would be a computer that controls the the machines are used to cut material, okay, or it might be used. It might be used to control a drill that punches a hole for something, or any one of a number of things, and they're buying this machine, okay, and so they're engaged in what we call a capital budgeting problem. Anytime we buy something that's going to last more than a year, we're making what we call a capital budgeting decision. We'll talk a little bit about that, okay? You're going to run into that over when you take finance, and then when you're out at work, you'll have those same kinds of situations. When you buy a house, it's a capital budgeting decision. When you buy a car, it's a capital budgeting decision. And what you're going to find is when you do either one of those two, like buy a car, buy a house, unbeknownst to you, the lender who you approach is looking at ratios and numbers and projected income and all of that, plus credit score, to determine if you can handle that purchase, okay? So that's how they do with consumers, because consumers often don't have some of the resources that a business do. Well, let's look at this just for a minute. And does it have all the elements we want for a spreadsheet? And it does, okay? We've got the title of it, okay, and what it tells us it's about. Then we have this area here that gives us the documentation. And then we see an assumptions area, okay? And then we have what we would call an input and data outcomes, or data area, reporting area. Now we come down to this table. And what we're going to do today is we're not only going to look at capital budgeting, okay, but we're also going to perform what we call a sensitivity analysis. A sensitivity analysis is a way that we take a couple of important variables, okay, and try to figure out if we change them, how does it change our outcome? And as we've gone through the course, you become familiar with using goal seek, which is in one of those what if tools. We also did some work with, I think, with the scenario manager. And then we can also do a sensitivity analysis using a tool called the data table, and we're going to use it today. Now, the whole point of this is to create something that visually helps us see what the range of our decisions will end up being, okay? Good decision making is always predicated on two things. One, good data, data that makes sense and fits. Number two, data that have been handled properly, which means computed, okay, and then presented in a way so they can be interpreted. When we make decisions, okay, our decisions are not binary. It's not right or wrong. Our decisions typically flow along a continuum of really, really bad or really, really good, and we want to kind of find out where does that all fit, okay? So we can use sensitivity analysis to help us understand it. It's no different if you've had statistics, maybe you have, is when you compute the mean, the median, and the mode, which are measures of central tendency. That is, how much do the data tend to cluster? And then we have measures like the standard deviation, okay, which tells us how much something tends to deviate, or the variance, which is the standard deviation squared, okay? And what we're trying to do is to understand how much the degree of variability or volatility in numbers, okay? Now, you see it and you live it with all the time when you deal with the stock market. You look at stock market, you'll say this, the market was up, the market was down. And if you go and look at charts on what they call intraday trading, you'll see it's just a whole series of lines. But if you look at the stock market over 25 or 50 years, you're going to see it's a long trend line upward. Over the past 25, 30 years, equities have tended to increase about 8% a year. Okay, now that's an average. But remember, there are times when, like the economic crisis, when the market plunged, we had a sell-off back, I think, a week or two ago, where the market plunged. I don't know, we're lost 10% its value, and it's going to climb back up. Okay, and again, we're always interested in variability or volatility. And if you ever listen to some of these, like CNBC or whatever, and you'll say, okay, well, the company reported X amount of earnings, and that was below analysts' expectations. Well, the company had said, we think we'll make 8% profit this year or this quarter. And then they report, well, we made 6%, and everybody gets spooked. But the company will have an explanation. It's what's called an earnings call. Or you maybe earn 10%, and then everybody's kind of asking, okay, what comes next? So we're always concerned about this continuum, okay, of decisions and the volatility in a set of numbers. So we're going to do this capital budgeting problem today, okay? And let's look at these assumptions. First of all, we have a thing called the interest rate. Now, that interest rate, okay, is also known as the capital hurdle rate or the discount rate. You say, what do you mean? When we do capital budgeting, we're talking about budgeting out a project that will be multi-year, okay? And so we're going to have to be concerned about the return on investment. We're going to have to be concerned about, should I make this investment, and what kind of payoff will I get? What we're saying right here is that the interest rate or the discount rate, that the company has to get that much back. Otherwise, if it could take it and put its money in a similar investment with a similar level of risk, it'd put its money there. Okay? And so why would you put 10% into this if you could get 15% using another machine, for example? Or if you could take the 15%, if the company could take the 10%, take that money that they're going to invest and put it into a portfolio, a stock portfolio, and make 12%. Okay, so we're always asking that question. Now that's what we call the reinvestment problem. There's another problem, and it's called inflation. Okay, now it's intuitively easier for us to understand that equal 100. Okay, times 1.1 is going to give us 110. And then we just compound the interest on it. We understand that. That's intuitively, it makes a lot of sense. But what doesn't make sense is what we call the discount, okay, or the present value of money. $100 today, okay, in 2018 will not buy you the same thing in 2019. Why? Because because prices go up. It's a thing called inflation. People want to raise. People raise their prices for materials, any one of a number of factors. And so if you have an inflation rate of 5%, okay, then the $100 that you have will buy you 5% less in terms of goods and services in 2019, okay? Now, you're too young to remember this, but I remember at one time, this is in the 1970s, the United States was experiencing an annualized, okay, 26% interest rate, which meant every month the prices of everything went up 2%, driven primarily by energy, oil. The oil lines you probably read about in history books, all that. So we're always concerned about, what will this buy me in today's dollars? What am I getting? Okay, so that 10%, that's also known as the capital hurdle rate, the reinvestment rate, the discount rate. We come down to a second thing called the salvage value. Now we're going to buy a piece of equipment. They tell us here this CNC, okay, and it's going to cost us $640,000. We got that accounted for down here. You say, why in the world would you spend that kind of money? Well, because we believe it will give us some improvements in productivity. We believe that by having this machine that maybe does things faster, a higher quality, etc., we're going to get about $130,000 a year in additional income. Okay? So that's going to be that additional income that we're going to look at 2009, 13, 14, etc. All right. So the salvage value is what I can get at the end of the budgeting period, because I'll sell the machine. Okay. Or if I'm just going to, if it's going to be worn out, that will be the value. Now, if you haven't had an accounting class yet, which I think probably many of you haven't, you'll learn about one of the fantastic things called depreciation. Depreciation is what we call a non-cash expense. It's where we account for how something gets worn out. Okay, and when you take the accounting, well, your principles of accounting, and then when you go take finance, Dr. Reader, you're going to learn about depreciation. Now, it is a wonderful thing, because what it lets me do is expense out a machine based on whatever guidelines. There are tables that the government says for certain types of assets. Here's what you can charge out, and it's non-cash, but it lowers your taxable income. Okay, and so when people talk about, for example, lowering the capital investment rate, what they're saying is, let's make it, raising the capital investment rate, let's make it, let's encourage people to make investments in equipment, etc. Okay, now that pretty much covers what's there on the front, on the very first page in 103, except for one thing, and that is what we call the net present value method. And the net present value method says this: if I get $100 from you today, what will it buy me in a year? What will it buy me in 2 years? What will it buy me in 3 years? Okay. Now, again, the future value is a lot more intuitive, because that is, I put money away today. Grandma gives me $1,000. I put it in the bank. I'm earning 3% a year, and the magic of compounding. But I always have to say, all right, I'm going to get the money in 20 years, but what will it buy me? Okay. I'll give you a real easy example. Back long ago, my parents were one of the first people who built in what is now known as Del City. Del City is a much different place. It was the boonies of Oklahoma City. Okay, and my parents had a top of the line house, and they paid $12,000. Okay, I guarantee you, a top of the line house today, you're talking $1 million. Okay, so that 12 grand that they paid was a lot of money back then. Today, it's not anything. And when I was the age of most of you, I thought, if I make $50,000 a year, I'm going to be rich. Today, $50,000 a year is, I think, close to the median income for a family in the United States. So we have to always be asking ourselves, what will this buy me in the future? Okay, if I get this money now. Okay, so this is one of the things we try to do when we do a capital budget, is to say, okay, I'm going to get these series of cash flows, but ultimately, what are they going to be worth? And in terms of today's dollars, what will they buy me? So we've got these three assumptions up here, and then we've got the input area. Now, in order to use the data table function, and let me mention that first of all, and we're really back over on page 104 now. Page 106 shows you an Excel, the tutorial for the case, and the data table command. Okay, and we're also going to use the edit fill series command as well, and you'll see what we're talking about there. So we're going to start here with the annual income from the investment. Okay, and this is going to equal B12. All right, and I'm going to go ahead and make that a full absolute cell reference. Okay. And then I'm just going to cover and I'm going to just bring this on over. Okay. Now, the authors are saying what we're going to get, because we buy this machinery, we're going to get an additional $130,000 a year. This is what we call an annuity. You'll hear people talk about that. So one of these days you'll be talking about your annuity program. An annuity is very simply a fixed amount of money paid for a fixed amount of time and usually discounted or compounded at a fixed rate. Now, the truth is that out in the real world, most capital budgets don't look like this. They start slow and they build momentum, okay? And so we're going to use the NPV tool. There's also a tool in Excel that's called XNPV, which lets us look at uneven cash flows, okay? So, and we'll maybe go back and visit that a little bit. Now we know we're going to make 130,000 a year. Notice I have the cell referencing in here. All right. Now we want to get the salvage value of the investment. So I'm going to come here at 2014, and this is going to equal that cell there, and I'm just going to go ahead and make that an absolute cell reference. Okay. So now we're going to come down and I'm going to come here to row 20. I'm basically going to start at row 17 and come down to row 20, and I'm going to use the sum, auto sum. Oops, let me back out for a minute. I don't want to get the year in there. I'm going to start at cell 18, come down here to 20, pardon me, cell 20. I'm going to come down to B21, and I'm going to click auto sum, okay? And then I'm just going to take that and carry it across. So you'll see at the end of this capital budgeting period, I get a bump in terms of that salvage value of the investment. Most of the time out in the real world, capital budgeting projects start pretty slow. They build some momentum, and then at the end, you know, you're starting to see things happen, okay? And you'll see that when you take finance course with Dr. Reeder. And again, we're working through a fairly simplistic process here. And now we want to get the total cash flow for 6 years, okay? And so we're just going to simply use equal sum, all right? And we're just going to come across. And so our total cash flow for those 6 years is going to be $990,000. Okay? So we're going to get $990,000. Now, that's not $990,000 in today's money, because what 990,000 bucks will buy today is not what it will buy tomorrow. And so we're going to do, we're going to compute the present value. We're going to use the NPV. Okay. Now, pretty simple function to use. Okay, and we're going to start equal NPV, and you'll see the little prompt, and it'll put, all right. And now I'm up here. I'm going to go up here to the formula bar, and I'm going to click on the function. The reason is so I can see the dialog box and kind of work through it. And as you recall, when I did we were doing the VLOOKUP and the SUMIF function, you know, it was big fun. So we have the NPV, okay, and this tells the returns the net present value of investment based on a discount rate and a series of future payments, okay. And so we're going to say, what is that money going to be? What is that money worth in today's dollars? So the rate over here, I'll click on B10, and the values. Okay, I'm going to come over here and get these sums, and that's going to be B21 to G21. And then I'm going to click OK. Now, you say, well, Dr. Harmon, why didn't you just click on that total cash flow, okay, and do that? Well, the reason is because if I do that, the machine's going to think I'm looking at 1 year, okay? So it assumes I have multiple values to do the NPV. So right now, at 10% discount rate, or let's call it a 10% interest rate or a 10% reinvestment capital hurdle, the money that we're going to get from this project is worth $684,000, okay, in today's money. Now, if we look down here, we start to see kind of a sobering reality, and that is that we're going to spend $640,000 to make $684,000. Okay, and the net present value of that investment is going to equal the NPV, and that's at B24, minus the cost of the investment. Okay, so that's the net present value of the investment. And we did the NPV up here to compute present value. Okay, and then we subtracted the cost of the investment. This is also known as the sunk cost. And you said, this sounds like the Badger Jams case. Yeah, for sure. We had to spend this money to get into the game. In this case, it's $640,000 for the computer numerically controlled machine. Now, okay, we want to say, okay, well, what about, well, that is not great. Well, as you recall, we have ratios to help us put stuff into perspective, okay? And so we have one called the profitability index, and the authors talk about that over there on pages 104 and 105. And the profitability index is pretty simple. It's the present value. In this case, it's going to be B24, okay, divided by the cost of the investment. And then what we're going to do, we're going to bring that down to 4 digits out. So we're going to decrease it to 4 digits. You say, okay, what are you telling me? What I'm telling you is this, that for every dollar we've invested, we're going to make 7 cents, 7% return. Okay? So at this point in time, you know, we've discounted it 10%, so we've met that. So the pure profitability or the net profitability is going to be about 7 cents on the dollar. Not too bad. 7% is pretty good. Again, if the market's earning you, 8 or 9%, and you think you can do without the machine, you might defer the decision. But for now, we have that profitability index. Okay. So far, so good. Now, we're going to come down here to cell. This is going to be B33. Come to row 30 for a moment. Click on it and insert a row. Okay. Now, so I don't want to do that. Wrong place. Back out of it for a second and come down to row 32 and insert a row. There we go. Now, you say, why did we do that? Well, we're going to do a little work, and here we're going to look at different profitability indexes we obtain given different levels of interest, okay? And given different levels of interest and different additional income levels. And so I'm going to come right here, and the first thing I'm going to do, I'm going to look at this B34, okay? And I'm going to put equal B27. This is what I call the hinge of the data table. And what we're going to do is, since we're going to build a link between those variables and then use the data table function. Now I'm going to come over here. Let me put it like this. Here's the y-axis. Here's the x-axis. We just have the x-axis up on the top. Now, I'm going to come to the next cell, and that's going to be C34. And the authors tell us that they want to look at different outcomes, starting with a 7% interest rate and ending at 13%. So the first thing I'm going to do is here, I'm going to put 0.07, okay? Then I'm going to come over here into the fill. And if you come all the way over to the editing, click on fill, and you're going to see a thing called series. Click that, and you'll get the series dialog box. Now, in this case, we're working in a row, and it says, what is the step value? Now, in the case they told us, they want us to come up 0.5% per iteration. So we're going to put 0.005. You say, Dr. Harmon, could it be 2.5%? Whatever works. We're just using what the authors have said. The company decided was they want to look at an increment of 0.5%. So we're going to look at 7%, 7.5%, 8, 8.5%, etc. Now the stop value, okay, is going to be 0.13. Now before we do anything, let's make sure, are we working in rows? Yeah. Do we have the step value that we want? Yeah. And do we have the stop value? Yes. So we'll click OK. And there it is. Okay. So now we have the interest rates. Now I added that additional row in because I want to identify these as interest rates. So I'm going to come up above there. In fact, I'm going to go ahead and I'm there in cell C33, and I'm going to click bold. So interest rates, we've got them flowing along here, and we go, and we're going to see what kind of profitability index do we get at 7%, 7.5%, 8%, etc. And we're going to end it at 13%. Now, if you come over to these two other rows, let's do this. Highlight them. Come up over into the borders area, and let's put no borders. And then on this last, we'll put a side border on it. And there's a right border, and there it is. It's okay. Now we've got the interest rates. So now you're saying, okay, these are kind of these are required returns, different levels. What's the next thing? The next thing we're going to look at in this case is the amount of money that we're going to get, the additional income. And there in the case, they want us to start with $100,000. Okay, and then they want us to increment it all the way up to $130,000. So I'm going to take I put in the $100,000. I'm going to come back over here to my friend Phil. I'm going to click series. This time I'm going to say the series is going to be in a column. The step value is going to be 10,000. And the stop value, what are they going to stop at? $160,000. And I'll click OK. And there we are. And then I'm going to come over here in, let's see, that's going to be A34. And I'm going to put, pardon me, I'm going to come down here to A35. And I'm going to put annual income. Okay. And I'll go ahead, I'm going to bold it. Excuse me, and I'm going to move it on over here by the table. Now, just to make this look a little bit easier for us, here where I've got the interest rates, I'm going to start here with, I'm on cell C34. I'm going to go ahead and put a value in. I'm going to go ahead and make that, give it a fill. And let's see, we'll do a nice blue fill. Yeah, that's pretty. And then I'm going to bold them. That's not too dark. And then I'm going to come over here on the annual income, and I'm going to use a green. Okay. And I'm going to bold it. That way, and I'm going to use, and I'm going to, this little hinge, which is the gateway for the whole data table. If you've done a sum product table, this is pretty much based on that, okay, or a lattice. Now, what we've got here now is the interest rates, okay, and then we have the annual income projections. All right. Now I'm going to use the data table function, and that's over here in our old friend. I'm going to click data, and I'm going to come to our old friend what if analysis. Okay, what if I do this? What if I do that? See, the incredibly beautiful thing now for us as business people is we have the capacity to build mathematical models before we ever launch out into the real world. And we're going to click data table. Okay. And now where we can get ourselves into an issue, okay, is what do I put in the row input table, okay, and what do I put into the column input table? For the row, I'm going to put the interest rate, which is B10, and for the column input cell, I'm going to put the additional income. Now I want to stop and talk about this for a minute. The row input cell is the interest, okay? You say, oh, okay, well, yeah, because that's the row, that's interest rate. Makes sense, doesn't it? You say, okay, then the column input cell is what? Well, that's the income. Now, because this is like a sum product or a multiplication table, sum product table, based on that, we're going to get these results, okay? Now, I'm going to cancel that for just a minute because I need to get my data. So I'm going to take my cursor and I'm going to highlight the whole thing. Okay. And then I'm going to come up here. Excuse me. Lordy. Here we go. I'm going to do the data table. The row input cell is going to be the interest rate, excuse me. And the column will be the additional income. I'll click OK. All right. And now I have my data table results. Now what I'm going to do here is I'm going to highlight all of this, okay, and I'm going to bring these down to 4 decimals. I'll click home, 4 decimals, and I'll decrease it down to 4. Now you say, okay, how can I check this to see if I did it correctly? Well, let's do this. Come up to 10% interest and look at 130,000. Okay, and there's our target value, and it's 1.0699, which matches over here. Okay. Now, you've got a recording here, so let me encourage you. If you kind of get stuck, always just come back and take a look at this. I'm gonna do this again, just so we're all on top of it and understand it, because it's easy to get yourself whacked out. Okay, now I'm just going to go ahead and delete all those in there. Okay, I'm going to do it again. Here at the hinge for my table, I'm going to come right here and I'm going to highlight everything. Then I'm going to come up to the what if analysis, which is under the data tab. I'm going to click data table. The row input cell, okay, is going to be the interest rate. That'll be over here at B10. And then the column input cell is going to be the additional income from the investment. And I'll click OK. Then I'm going to come in here, and these interior cells, these output, I'm going to take them down to 4, no more than down to 4 decimal places, because that statistically is a pretty good figure. Then I'll check to see, do I have 106? Yeah.
Mine didn't have the key.
Okay. So okay, that's wonderful, but boy, that's a lot of data, and that's true. So there's something that we can do to help us visualize this and start to look at the relationships. When we do a sensitivity analysis, what we're trying to do is establish a relationship between two important variables. Now, we've done correlation coefficients. We did that. We did the linear trend line. Remember, we did that case. And so sensitivity analysis is, okay, if I change one variable, or let's say if I change two variables, how does it change my income? My output, excuse me. It's tax time, what can I say? Well, here's what I'm gonna do. I'm gonna start here inside, and that's cell C35, and I'm gonna highlight the whole area of the output. And I'm gonna come over to one of our old friends, conditional formatting. You see me use it a lot. And the reason I do is, first of all, it's easy to use. And number two, people see weather so much now that they understand intuitively what all those different colors and things mean. So I think the more you can present something in that nature, we call it a thermal, the better off you are, okay? And so I'm going to click color scales, and I'm going to come over here where we're green, and here we have something. Now, you say, oh, that's interesting. It looks kind of like a rainbow. I've got this top line that kind of starts out pale and then gets redder and redder. I've got this kind of yellow area, and then I've got this area here at the bottom that starts out kind of green and then gets really green. Okay? Now let's do this right now. If you've been following me, I'm going to save this. I'm going to talk about it. What is this telling me? This is telling me, okay, that there is a seriously strong relationship between interest rate, or the capital hurdle rate, and annual income. I already know that, but I want to see the extent to which it impacts it. And let's look at this. If I look at this chart, okay, and it's important that one of the reasons I gave you guys the textbook, Show Me the Numbers, is you're going to be looking at tables and charts for the rest of your life on things called dashboards. You already see stuff. When you start your car, you're already looking at the dashboard. You'll see how much gas you've got, etc. It's the same thing when you're out at work. Those 4 or 5 important variables the company wants you to track or see. So I can look at this and say, okay, as the interest rates go up at any amount of annual income, the profitability index decreases. If I'm at the highest income rate of $160,000 a year and I'm at 7% hurdle rate, I'm at 1.41. If I come over here to 13%, I'm at 1.15. Let's call it 1.16 among friends. So there's a relationship between the two of them, and this helps me make a decision on, okay, what am I going to get in terms of the profitability index versus investing this money somewhere else. Now, philosophically, all of this comes back to an important thing. When you're out running a business, and even if it's yours as you start up, chances are you've got other investors. And it's not your money. You're playing with other people's money, okay? And so if you're going to do that, be sure that you get them what they deserve or what they think they ought to get. And so that's why this interest rate, this term right here, is kind of a misnomer. It's really the required rate of return, or we call it the capital hurdle rate. As you can see, okay, as the annual income goes up, the higher the profitability index. The lower the income, the lower the profitability index at this extreme. You say, okay, where are we? Well, we're right here, about in the middle. And I'm going to bold that up. And I'm going to make that, let's make that a 12. Because that is what we would call, I'm going to make that a 12, because that's what we call our base case. We just got through running through all of this. Now, we're going to do some things stylistically here to make this look a little prettier and a little more understandable. Excuse me. In the assumptions area, I'm going to do this. I'm going to highlight it, and I'm going to highlight it with a very nice I think I'll use a blue and make sure everything's bold. And then I'm going to put a nice thick box border so it catches the user or reader's eye. Oh, okay, assumption. This is what I'm assuming. Okay, and then the salvage, and then we're going to have here's our title to our input table, and I'm going to bold it up, and then I'm going to come over here, and I'm going to follow that same pattern, and in this case, I'm going to use a green, nothing too icky, a nice green. Now, since this is more like a chart, I'm going to come back here, okay, and I'm going to go ahead and put all borders. Now, the beauty of this recording is you can play it and record it, replay it. And so let me give everybody some coaching, because I know we've got a few of us here and then some of you out there in TV land, and I'll have a lot of other people watch. If you have a question about something on one of these recordings, once I've saved it and I've put it up at YouTube, give me the minute and the seconds, or approximately the minutes where the question is, and then I can try to answer your question, okay? And that would be the best way to pinpoint it. It doesn't get any better than that. I guarantee you, when I sat through lecture after lecture after lecture all my life, I thought, oh, why can't we record this? Well, here we are. Thank God we finally got there. So I've got my capital budgeting analysis, okay? I've got my data table, and I know that I have to, if I want the best result, this is the base case, okay? My best case is going to be over here where I have the lowest interest rate and the highest annual income. My worst case is where I have the lowest income and the highest. So I'm going to do that. I'm going to click there in that cell at the intersection of a 7% interest rate and 160,000. And I'm going to bold that. And I'm going to size it up to 12. That's my worst case. And then my best case is, that's my best case. Now my worst case is over here. Lowest annual income, the highest interest rate. And I'll pop that up to 12. Now you say, why did you do that? Well, simple. I want to look at the range of outcomes. This is a beautiful picture. It looks a whole lot like a rain map or intensity of rain, something like that. It was like, but okay. But I'm also curious about this. So what I want to see is, all right, what are my possible outcomes, and I can see them. Worst case scenario for me is making 78 cents less than a dollar return, okay? Losing basically 22 cents at least. My base case is about 7%, making about 7 cents on the dollar. Here I'm losing 22 cents. And then down at the best case, okay, I'm looking at making about 41 cents a dollar, 41 cents on the dollar. So I would probably do this. I'm probably going to put best case. All right, and I'm going to put in that 1.4103. All right, then I'm going to put base case. And that's going to be, and that's going to be that 1.0699. And then worst case, okay, is going to be 0.7822. And I'm going to go ahead and bold those up, put borders around them, and I'm going to fill them in. I think what I'm going to do is I'm going to set that off. I'm going to use a salmon, not too much. That's about right. And I'll go ahead and make them, I'll highlight those, and I'm going to make these like 14 so I really see them. Now I can see it, and I'll smudge these out if I need to, or do the wrap text. Doesn't matter either one.
I just get on so he knows that I'm on.
But now I can see, and I'll go ahead just to make it, I'm making it look pretty. Let's go ahead and put them all in the middle. Now I can see the kind of variability I have. You say, well, okay, would it be possible for me, Dr. Harmon, to compute the average of those? Certainly. Would it be, could I compute the standard deviation of them? Yeah. Is there a lot of variability? You bet there is. We're going all the way from 41 cents on the dollar, okay, to losing 22 cents on the dollar. And we think kind of basically where we are, you know, we'll make about 7 cents. So we have some real variability here, and that variability is due to two things. First of all, the interest rate. Now, out in the real world, if I put something like this together, and this is the interest rate or required rate that the company earned, I'd say, okay, that's not the factor. The factor that's important then is the annual income. Can you get more than 130 grand? Is 130 good? Can you get this machine cheaper? Can you get it for less than 640,000? And again, that's going to be on that. You know, that's going to be based upon whoever's got those numbers and put them together. Now, my advice to someone if they're doing this is, I would say, okay, if you know how much the machine, you know how much this is. Most companies know what their capital, what their interest rate is, or the required rate of capital. You say, how do you know? I'm gonna make some of you mad because you're gonna take a finance course and you're gonna do all kinds of mathematical hoops to jump through to get that. The truth is a capital investment rate, the required return for any company is basically how much the interest rate somebody will charge them to borrow money.
It's only
yeah, makes sense? It does. And I found that tends to be a pretty good rule of thumb. But the next question is, okay, those 130,000, could I simulate those numbers, okay, and look at different futures and outcomes? Absolutely. That's what this tool is designed to do. And you could go through several scenarios here, or several possible futures where you take the annual income from the investment and look at it. Of course, the table tells the tale down here. You can look in the table and you can imagine those. And if you think the range of $100,000 a year is good, 100,000 to 160,000,
yeah,
then away you go. And again, you could say, you know, I'm looking at a worst case scenario of 100 grand a year I get back. The best case is 160,000. That's about a $60,000 bump in there, or $60,000 variation. Okay, I'd want to think about that, because that's a little bit of variation, maybe a little more than I would be comfortable with. But you could also go out and look at the machine. Do I have to pay $640, or could I pay $620? Could I pay $600? Now, when the author, and now we've basically gone through everything that the authors asked us to do over on page 104 and 105 in terms of the tasks, okay? And then, as they like to do on 6 and 7, that's on page 105, they say, you know, they're on 7. Yeah, I think they ask you to utilize them. Should they make the investment or not? Okay. Well, we go back to this question of, all right, what's my interest rate, the required rate of return? It's 100. It's 10%. Now, we deducted that when we effectively did the present value. And let's look at that again, and we'll click on the formula. The rate's 10%. We put in the values, okay, and we got that 684, whatever it is. Now, the nice thing about the dialog box is you can always click help on this function and it will explain it to you. So is this a good investment? Yeah, I'd say I would go with it, because you're using, you know, some fairly reasonable figures and you're good to go. So we're using the NPV function. Now I'm going to take just a minute, and I want to show you another tool here that you can use. Let's say that I have let's say that let's just put 2018, okay? And I'm going to use my friend Phil, 19, 20, 21. And 19, 20, 22. I'm going to go to my friend Phil, and I'm going to do a series, and I'm going to do a row, and the step value is going to be 1, and the stop value will be 2022. So that's going to work out for me. Thank you. Very nicely done. Now these are this is 1, 2, 3, 4, 5 years into the project. Okay, and I'm gonna, let's say I'm gonna make the first year, I'm gonna make $25,000. Okay, next year, I'm kind of still on my way. I'm gonna make about 31,000. Okay, and then I've kind of got my sea legs there. I mean, I've kind of got this thing going on. I understand it, and I'm kind of through that crucial period, you know, where I'm walking around and I'm here. I'll go ahead and make these all in the middle anyway. Make them look pretty. And now 2020, things explode. I make 50,000. Okay. And then the next year, I kind of level off at 52,000, and I bump up. I've got some experience under belt, and I bump it up a little bit to 57,000. Okay. Now there's a function in Excel. This is what I would call an uneven cash flows, which is more realistic than this annuity. Okay. This is more likely. And we'll make sure they're all in the middle. In fact, most capital projects out in the real world actually start in the hole, losing money. So just to make this realistic, I'm gonna put minus. I'll put it minus 25,000, and then we climb out of that, and then we kind of plateau. All right. Now I'm going to use the XNPV, and so I'm going to put equal XNPV, and I don't know if we have the function here or not. Okay, and I'm going to click on the function. Oh, it does. Very sweet. The XNPV is for what we call uneven cash flows. And I'm showing you this, okay, so you can understand that capital projects typically are not annuities. The only annuity you ever want to see in a capital project is your retirement fund, where you get the same amount every month, and it ought to be a lot. Remember, you'll want to be living on it. What is this, 2018? 50 years from now, most of you be ready to retire. You know, you're talking 2068. I won't be around, but let it be said by me, save often and save early. Now, we're going to put a rate in here, and let's say my hurdle rate is 0.085. That's pretty reasonable. And the values, okay, I'm going to get my values. Now, I can't remember if we have to have all positive or if we can absorb a negative. I think we can do a negative. And then the dates. Okay. And I'm ready. And I click OK. And we'll go ahead and let's put that into dollars. Now, based on this series of cash flows, I'm going to make the present value is $164,884.93. Now let's just go ahead and sum these and see what it is in raw dollars. Okay, it's 165,000. Right? Yeah. You say, what killed us? Well, right here. And that's pretty typical. You remember we did Badger Jams and we talked about the break-even units? and we came up with 1,147 break-even units, which meant they were going to have to sell 52 weeks, let's call it 50 weeks of selling per year. You're going to have to sell, 20 some odd cases of the stuff, every week. Chances are it won't work out like that. You'll sell, 150 cases or 200 cases before Thanksgiving, then a bunch of it at Christmas, and then it'll all start being regifted, unless it's really good. And I got the total here. I wanted you to see that. Now, since we're talking about this, and I'm going to encourage you again, what really discourages me or disturbs me is when in class, and I think I've done it with all of you guys when we met, is how many of you are enrolled in Dr. Reader's course on personal finance. And I'll usually see a smattering of hands. I cannot implore you enough, take that course. It is worth it to know how to handle your own money. And I'll say it, you'll hear me say it again. What a tragedy if you'd leave learning how to handle everybody else's money except your own. It's kind of like the cobbler's kids have no shoes. And it would be ridiculous. And I'm going to tell you now, you want to do that so you have options when you hit that point in life where you want to maybe, go around the world, or you want to work, you don't want to work, but it gives you some options. And the other is ultimately, if you do that budgeting, okay, and you're a believer, then you're in a position to meet some of your financial obligations with the good Lord. And I'll leave it at that. So you want to be taking that class. The XNPV lets us look at uneven cash flows, which are more realistic. Now, when we talk about the present value of money, I want to make sure that you understand there are four kinds, and you'll get this when you do Dr. Reader's class, or if you've had a finance class somewhere else. You have the future value of an annuity. If I put back, 6% of my income a month for the next 40 years, what will I have? Well, it's an annuity. It would be an annuity because I'm putting back a fixed percentage for a fixed amount of time. Okay, and so when your parents have a retirement account, I have a retirement accounts. I put money into them every month. That's an annuity. Okay, we also have a lump sum. Okay, a long time ago when I was your age, I had an uncle who was very wealthy, and I believed he loved me more than anyone. And I thought, I'll get his millions when when he croaks. I didn't get the magic money, so I lost the lottery. So that lump sum, and I do lump sum equations, and then it didn't work out. Okay, unfortunately for me. So thank God I was saving. So we have the lump sum, the future value of a lump sum. If I have if I have $10,000 today, and I just let it sit, what will it be worth? Then we have also, on the other hand, the discount, the present value of an annuity. Okay, and one of them that we did, I showed you what we call the equation it's for an endless annuity. And if I want to make $100,000 a year, and my nest egg earns me 2.5% per year. How big does and I don't want to touch my nest egg, okay? I just want to I don't want to touch the nest egg. I want to just use the interest. Here's what I got to have. All right. I'm going to do that in that equal. And we'll put that in dollars. Wow. So that should give you some food for thought as we look at it. Okay. That's, in fact, that technically is called the formula for a perpetuity. Okay. And what we do is we take the nest egg, the amount of money there, and that we're earning interest on, we divide it by the rate of interest, and it shows us how big the nest egg needs to be. Okay. All right. We started 15 minutes early, so I think we've done pretty good. We covered, we did some more formatting, and covered capital budgeting and what that's all about. We use the NPV, the X and XNPV. We did the fill series. We created a nice little rainbow here, which is wonderful, which is, the sign that, we won't get flooded again. And we looked at base case scenario, worst case. We even did a little, as I said, a little XNPV. And so, not bad. And so we've done case 11, and I'm going to save this and close it. And you want to upload it where it says upload XLS 11 here. Close it off. Okay. And I'm going to save it. And then we'll come back up here and you'll want to upload your file. Okay, folks, I'm going to stop the share and then stop the recording and we be done. Thanks for those of you out there who showed up. Got one here. And that's good enough for me because I know there'll be a lot of people who work on the test today and who will come back and take a look at it later on. Okay, I'll stop the share and then I'll stop the recording.